On April 23, 2023, Bed Bath & Beyond announced they were filing for Chapter 11 bankruptcy. Your first investing lesson is that investors underestimate the potential for large companies to go bankrupt. Bed Bath & Beyond used to be an incredibly innovative and successful company. Bed Bath & Beyond offered unparalleled convenience for shoppers by having every bed and bath product a homeowner could dream of in a single store. Before the popularity of online shopping, this was a very effective business model, and Bed Bath & Beyond was making billions in revenue every single year. But eventually, the convenience of online shopping forced Bed Bath & Beyond to innovate again. Bed Bath & Beyond launched their own private label goods. Customers would be lured back to Bed Bath & Beyond since these private labeled goods could only be found there. Additionally, the profit margins are better because you're producing the goods yourself instead of buying them from a third party. This strategy has been very successful for Costco, Whole Foods, and Target, but this innovative move came too late for Bed Bath & Beyond. Unless a major investor gives Bed Bath & Beyond a last-minute bailout, Bed Bath & Beyond is going to join a long list of multi-billion-dollar companies that went bankrupt over the past 20 or so years. Enron was the 7th largest U.S. company before it went bankrupt. WorldCom was worth $175 billion at its peak. Lehman Brothers was the 4th largest investment bank in the United States with 25,000 employees before it went bankrupt. Bear Stearns was sold to JPMorgan Chase at $10 a share in 2008. A sharp difference from the $170 a share it sold at a year prior. During this past year, Silicon Valley Bank, Signature Bank, and Credit Suisse all suffered similar fates. Not only do multi-billion-dollar companies fail, but also entire countries fail. During Berkshire Hathaway's 2021 shareholder meeting, Chairman and CEO Warren Buffett compared the largest 20 stocks from March 31st, 2021 to the largest 20 stocks from March 31st, 1989. The 2021 list is full of companies you'd expect to see, from Apple to Microsoft to Tesla and many more. The list is dominated by US companies. The 1989 list is mostly companies you've never heard of. The list is mostly Japanese companies, and the few US companies that made the 1989 list did not make the 2021 list. Japan would suffer a massive economic crisis in the 1990s. The Nikkei 225, which is an index representing 225 of the largest Japanese companies, took 30 years to recover. US investors got a taste of that possibility after the dot-com boom. The stock market was almost recovered by 2007, but then 2008 shook up the US economy. Only after recovering from 2008 did the US stock market make real progress. Most investors will be invested in the stock market for 60 to 70 years. You will likely start investing in your 20s and 30s and continue to invest in the stock market for the remainder of your life. During the next 70 years, you will watch the rise and fall of many companies and countries. What companies and countries you view as safe today might be tomorrow's disaster. Having a diverse portfolio is how you ensure that each bankruptcy or countrywide issue is only an inconvenience. Diversification is also important to make sure you are invested in tomorrow's winners. Apple joined the stock market in 1980, Microsoft joined in 1985, Amazon joined in 1997, Alphabet joined in 2003, Tesla joined in 2008. These companies that would dominate Buffett's 2021 list were tadpoles in 1989. Some like Amazon, Alphabet, and Tesla weren't even founded yet. Looking ahead at the next 30 years, these juggernauts will likely be overturned by new companies you've never heard of, potentially coming out of a country you've never thought about. The next investing lesson is that hype is dangerous. Wall Street Bets is the name of the world's largest online investing forum and has a well-deserved reputation for treating the stock market like a casino. This forum blew up in popularity when Wall Street Bets members poured tons of money into GameStop stock. This drove up the price of the stock and allowed the members to profit at the expense of hedge funds who were shorting GameStop. After GameStop, Wall Street Bets was trying to find the next big meme stock that could make them some money. One of the targets was Bed Bath & Beyond. The Bed Bath & Beyond hype skyrocketed when Ryan Cohen bought nearly 10% of Bed Bath & Beyond. Ryan Cohen is the chairman of GameStop, and Wall Street Bets loved him. The news resulted in a thread praising Cohen as the meme king. That thread had over 10,000 upvotes and over 1,000 comments. Wall Street's Bets love of Cohen would be betrayed when the news broke that Ryan Cohen sold his entire stake in Bed Bath & Beyond several months later, during a massive meme stock rally. Cohen walked away with over $60 million in profit. Wall Street Bets got to enjoy the losses. Bed Bath & Beyond is yet another example of how stock picking struggles against index funds long term. The Vanguard Total Stock Market ETF mimics the entire US stock market. From 2008 until 2016, Bed Bath & Beyond stock was crushing VTI. But after 2016, VTI took the lead and never looked back. Index fund investors also never had to worry about the risk of losing everything. For VTI to go to zero, about 4,000 US companies would need to go bankrupt at the same time. The only way that would happen is if the apocalypse occurs, and if that happens, you'll have bigger priorities than the value of your investment portfolio. VTI is invested in Bed Bath & Beyond, but that investment is a fraction of a percent. The loss is barely noticeable. For investors who have bought tons of Bed Bath & Beyond stock and believed in the siren song of a turnaround, Bed Bath & Beyond's bankruptcy is financially devastating. I hope you found these lessons useful. If you enjoyed this video, make sure to subscribe for more.